Okay, good morning, everyone. We are, this is Thursday, October 16th, and we are covering today the beginning of Chapter 7, dealing with cash and receivables. And I just kind of want to brief everybody as to where we are. This is usually uh, how I usually start the class session is just saying where we are and what are the due dates and whatnot. So um, I have recorded some videos that sort of were supplementary to Chapter 6, dealing with revenue recognition. And I want to sort of round that out a little bit. Chapter 6 is a really, really dense chapter, and I think I told everyone that. So it's really more than what I can cover adequately in two class sessions, which is 2.5 hours. And there's a lot going on, but that's sort of the nature of intermediate accounting, and that's sort of the rules of the road here. I mean, these are not set by us necessarily here at C&M. It's intermediate accounting is pretty much the same everywhere else. They may differ in terms of the order in which things are covered, the textbooks which are used, but we do cover really the same topics, and they're dense, and there's a lot of work to be done. So, which is why if you have questions, you should get me individually about any of these. So, on Chapter 6, I'll probably post one more video just because I'm not quite done yet talking about revenue recognition, particularly as it relates to this time frame, and that's one of the things that I think was most important to discuss. So I probably can't get to it today, frankly, because I don't have really access to the rooms in which this technology is available. So I'm going to push back the due date for the quiz at least to Sunday. So if you haven't taken the quiz yet, if you haven't, it's fine. But if you haven't taken it yet, I'm going to push it back to the 19th because I will not have yet posted the final video on that. And you'll see this probably throughout the semester where there's just a lot to discuss, a lot to go over. And I do like to kind of, as we get going deeper into this, talk more about what is the actual accounting treatment. And by that, I mean, how do we deal with particular events, transactions, adjustments, and whatnot. And so I really want to spend some time talking about that. So in that regard, I think this is what makes intermediate accounting what it is. It's sort of the untraded profession, as I said before, and so as a result, it requires lots of discussion. So I'll be moving this due date back. Usually, the Friday Sunday methodology, I actually kind of like. Actually, we have what we call course owners, and I don't own this course. Who designed the syllabi and the course design itself. I've done my share of course design. I will have to say I do like this idea of spreading out the two due dates there, the quiz and homework. But in this case, because we're just have a lot to do, this is one of the denser chapters, Chapter 6. I'll push that back. I haven't yet changed it in Brightspace or Connect, but I will. Okay. So we're going to move into Chapter 7 today because we want to sort of keep pace with what we're doing here. And we're going to talk about Chapter 7 and what it's about. The due dates, nothing to do this week on Chapter 7. And my plan is to hopefully get through all of Chapter 7 by no later than maybe the half class session on Thursday, so that we get into Chapter 8 dealing with inventories. And inventories themselves are always a complex issue, particularly in intermediate accounting, because we study different methods by which we record inventory valuation. And these are probably, at least in my experience, some of the more challenging issues anywhere in accounting, in financial accounting, is adjusting an accounting for inventories. It just is one of those tricky areas, and it's sort of no wonder that the biggest area of our economy, the fastest growing area, has very little inventory, whether it's technology or consulting or services in general. And whatnot. And nonetheless, inventories are an important part of an accounting education. So we're going to talk about that. So, okay. So that's what's going on with where we are today. So I will change the due date for the Chapter 6 quiz. I'll do that when I get back to my office, and we'll sort of go from there. So let's get into Chapter 7 and talk about what's going on. So before, at the outset here, what I want to say is that just to kind of give you an overview over where we're sort of heading toward the rest of the semester. The rest of the course basically focuses on the balance sheet, right? Back in Chapter 4, we talked about the income statement. We talked a little bit about the cash flow statement, or I guess Chapter 3, I should say. A little bit about the cash flow statement. And that comes up, that's a pretty tricky statement for a lot of reasons. And that is covered much more in Intermediate 2. But as I've said at the outset of this course, I think how I describe intermediate accounting to people is it's sort of a walk through the financial statements. the main four particularly, but also including the statement of the OCI statement, that is any kind of supplementary income or whatnot. But those main statements, but really delve deeper into them, and that's really what I think is really what's going on. So, balance sheet, income statement, where the comprehensive income statement applies, and again, that's at the discretion of the reporting firm itself, and then the statement of retained earnings, statement of cash flows. And in this case, we're only really going to be focusing on the balance sheet as we go forward here. So once we get out of Chapter 6, for those of you who are still working on it, we're only talking about the balance sheet. So what are we doing on the balance sheet? Well, we're going to talk about current assets in Chapters 7 and 8, and that leads us up to the second exam. Okay, and the first part we'll talk about is cash and receivables, particularly accounts receivable, but we'll get into a bit of notes receivable and whatnot. And some of this you may have seen before. One of the things I mentioned previously was the idea that the first 4 chapters in this course may be a bit of a review. They kind of go back over what was covered in introductory financial accounting, but once we get going deeper, or further in the course, we do a bit of a deeper dive into these. And so Chapter 7 and 8 are going to deal with those current assets. Then we're going to move on to long-term assets, which we call PP&E, property, plant, and equipment. We'll talk about all the issues that surround that, and investment in technology and equipment and whatnot. And then we're going to go over the right side of the balance sheet. So that's the left side of the balance sheet, current assets, or all assets, basically, the left side. The right side is going to be discussion of liabilities. We'll talk about different kinds of liabilities and how we account for liabilities and all the various issues going on there. Notably bond issues, which are very prevalent in a lot of publicly traded companies. And then finally, we'll get to shareholders' equity and all the issues surrounding shareholders' equity. So having said all this, though, the effects on the income statement, so even though it's a focus on balance sheet, the effects on the income statement are always going to be there because it's always a consideration. So what happens on a balance sheet oftentimes translates over to the income statement through a process we call articulation. So this is a reality. And so, yes, we're talking about the balance sheet. That's the focus, but it's also going to have ramifications elsewhere. And by the way, if it affects the income statement, how can it not affect the retained earnings statement? How can it not affect the cash flow statement, right? So all these are sort of related. Now, the cash flow statement sort of stands a little bit apart because it's just tracking cash in, cash out, that sort of thing. But nonetheless, there are effects that go on here. And so changes in any particular account will change reporting elsewhere. So that's where we're going with regard to cash and receivables. So let's quickly sort of move into what we're talking about here. So we're talking about current assets, and if you go to the left side of the balance sheet, I say left right because it's kind of the maybe it's the old school methodology, I don't know, but we're talking about the asset side. Always the first item listed is cash, but it's usually not just cash as a single line item, it's cash and equivalents. And when we talk about cash, this is not all that difficult to understand. This is cash that's available to be used. It's currency coins. More likely, it's balances in checking accounts or money that's held in various checking accounts and whatnot. We talk about equivalents. We're talking about things which are substantially the same as cash, and they're so near to cash that we might as well include them in cash, and we do. Things like very liquid investments, like money market funds, where you can redeem them very, very quickly, and whether they're FDIC insured or not, typically they're not. They invest in a lot of very short-term instruments, and they typically pay interest, maybe not a huge amount, but they do pay interest. But all these that have a maturity date cannot exceed 3 months from the date of purchase. And so treasury bills are sort of tailor-made for that. And right now, the treasury bill rates are actually higher than the intermediate rates on things like treasury notes. So treasury bills have become fairly popular here in the last year and a half or whatever. And so a lot, Warren Buffett and his firm Berkshire Hathaway supposedly own about 5%, which doesn't sound like very much, but 5% of a gigantic amount of the country's treasury bills, just because there's a very high rate right now. But they're considered liquid because you can sell those very, very quickly, and there's instantaneous. Like if you want to sell them, redeem them for cash, you can do it. People move in and out of all these all the time. Commercial paper, these short-term obligations, usually arranged through investment firms where companies have excess cash, they want to do something with it, and companies have a need for cash, and so that some counterpart or some intermediary puts them together and creates what's called commercial paper, usually unsecured but always interest bearing on a pretty short term basis. And so that's an example of a cash equivalent. Definitely within 3 months. In fact, commercial paper doesn't last anywhere near that long. Treasury bills may, but you get the idea. So cash and equivalents. Now remember, and we just kind of go back to something we talked about in Principles 1, it's the idea of liquidity and how we order assets on the balance sheet. We go from liquid, most liquid to less liquid. So we go downward on the balance sheet in terms of liquidity. And again, the term liquidity simply means the ability to convert something to cash. And that's really all that it really means. So cash is obviously already cash, so it doesn't get too much easier. And then the cash equivalents themselves are also very, very liquid. By the way, if you have a treasury bill and you need cash the next day, you can just simply sell the treasury bill. It's no big deal. It's a very, very simple transaction, and it's very liquid. And treasury bills, what we're talking about, issued by our government. It's one of the ways that our federal government raises cash through bills, notes, and bonds. Those are all different maturities, and treasury bills are very, very short-term maturities, and they're very extremely liquid, and they do pay interest. But if one needs to raise cash, actual cash, not just an equivalent, they can simply sell them on a really instantaneous basis. Okay, this is an example of what a disclosure might look like. And Walgreens Boots Alliance, I think Boots is a British company actually that sort of teamed up with Walgreens to form this particular joint venture. And this is an example of what a note to the financial statements might look like. I'm going to get back to notes, and one of the things you'll see me do, maybe more than the other instructors in accounting, is really sort of delve in and drive deeper into these statements that are reported, the 10Ks, the 10Qs, Ks being the annual statement, Qs being the quarterly statements. But the notes themselves, which tell a big story as to what's going on, because it's one thing to sort of report a line item on a balance sheet, but what does that consist of, and what are the issues that are behind it? What are the elements that compose that particular line item? And so when we're talking about cash equivalents, in this case, this is a pretty good example. And it doesn't say what year this is from. Oh, I guess it's 2017. Cash equivalents on hand or all highly liquid investments with an original maturity of 3 months or less. Remember, that's the gap requirement here. Credit, debit card receivables from banks. This is something we don't really see a lot of in accounting courses, but nonetheless, you will see it in financial statements. Is the idea that sometimes companies are actually waiting to receive payment from banks. We think we go anywhere, we go to Target and we buy, I don't know, buy a pair of shoes, and the money is transferred immediately. Well, sometimes not really. It has to go through the banking system, and it's not always an immediate sort of thing. And so these are receivables, and it's not really cash, but it's pretty darn liquid. And so it's going to be collected in a fairly short order, but it's not the instantaneous transaction that I think a lot of people think it is, despite the fact that the money may come flying out of your account, right, quicker than whatever we thought of before. And so that's a whole other issue concerning float, what we call float, but nonetheless, that money does come out of your account at one point, but there is a bit of a delay. So there's a receivable. In other words, it's a cash equivalent. And remember, what cash equivalents are is this idea that we can convert this to actual cash in a very, very short time period. So much so, and so reliably so, that we might as well just say it's really part of the same issue. Okay. All right, let's talk about internal control briefly. This is really a topic that comes up a lot in accounting. It certainly makes its way over to the auditing field. When we talk about internal control, what we're really talking about here is the idea of companies safeguarding, and I think it kind of comes from cash in particular, safeguarding cash, safeguarding valuables and whatnot, but it's really more than that. And just to limit that to limit that view is to really limit an understanding of what we're really talking about with internal control. We're talking about adherence to policies and procedures. That's one thing; those are internal policies, but also the external regulations and laws and whatnot. So internal control is not a small item, and it's in fact in Principles 1, I think chapter 5, I believe, is the chapter we dedicate an entire chapter to internal control, and it's this idea of how do businesses control the things of value, and how do we particularly protect ourselves against theft. And we think of theft as being an external issue where we got people outside the organization stealing from us. But what about internal theft, which is maybe more common? I don't really know. I'm not a fraud examiner. There are people who are CFE certified fraud examiners, but I don't know what the ratio is of external and internal theft. But internal theft, I can tell you, is not a thing to be taken lightly because internal actors, employees, contractors who are brought in, have access to a lot of information that external actors do not. And it can be a very difficult sort of situation. I know that the first company I worked for right out of college had actually terminated some people that they didn't do a very good job of scrutinizing their background. As it turns out, they were members of an organized crime group that was really seeking to get into our systems in order to do whatever kind of malicious damage they were going to do. And that was on us, and that was a lesson learned. When I say us, it wasn't me, but it was our organization. We had to kind of deal with it. And that's a big issue. Internal control is a much bigger issue than what we're getting into here. We talk about it here because it really relates, in particular, to cash. And most accounts will say that the protection of cash really needs no explanation. There's no explanation for why we need to control cash, but also other valuables as well. But here's the thing: internal control extends a bit beyond what we talked about in 2110, where a lot of it was protection of cash and all this. And yes, we talk about dual control or segregation of duties and whatnot. We'll talk a bit more about that. But it's also internal control is an issue where the law itself is weighed in, including the Sarbanes-Oxley Act of 2002. And what Sarbox did was do a lot of things. It's a very dense law, and I've had to read every word of it, unfortunately. But it does require that companies document whatever's going on with their internal control systems, and more importantly, that they require the CEO and the CFO, these are public companies, right, to attest to the fact that they individually, personally, with their own legal liability on the balance here, they attest to the fact that the internal controls have been inspected by them and that they agree that they are adequate to ensure accurate financial reporting to external users. And that's essentially what's going on. So 404, which is section 404 of this particular act, has them. And we'll get to an example here. In fact, let me do this right now. So I pulled up an example, and I like to, as I've said before, pull up different examples of public companies and what they're doing with regard to filing and how this might look. And so I pulled up here, if I can find it, and I'll bring up this. Let me see here. I think I've done Procter & Gamble, and I know I've done Apple, and I want to kind of mix it up so that I don't use the same company every time. This is going to be Boeing. If I can shrink this a little bit, this is too big here. Let me shrink it down a little bit. So this is Boeing, okay? We all know what Boeing is. They make aircraft and whatnot. So this is their 10K filing, and it's as of the year end 2024, I believe. Let's see the date here. Yeah, as of the fiscal year end, December 31st, 2024. And when we say fiscal year end, some companies have fiscal year ends of really odd dates during the calendar for their own particular reasons. In this case, a lot of companies have a fiscal year end. That's the calendar year end. So this is sort of what it looks like. Now, there are no signatures on this, but I'm going to talk about some of the various pieces of this because I really think it's important for us to understand what's really required in terms of the Sarbox disclosure requirements. And so let's take a look here. Let's cross slide to the beauty of this website. And by the way, the Edgar site, it's a free site. Anybody can get into. Edgar simply stands for Electronic Data Gathering and Retrieval System. It's maintained by the government. As companies report their information, it's available. And so let's click on 9A here, and that's controls and procedures. And here there's the company itself, right? This may be very small to see, and if you really want this, I can send you the link. But it's not hard to find. And so what is it saying here? It's saying our chief executive officer and chief financial officer, and those are the two parties individually have to sort of sign off on these statements, have evaluated our disclosure controls and procedures as of December 31st, 2024, and have concluded these disclosure controls and procedures are effective to ensure the information required to be disclosed by us. It's a very long sentence. I'm going to take a breath here. Then we file or submit under the Securities Exchange Act of 1934, and well, whatever. So anyway, what is really going on here is the idea that the CEO and CFO are both attesting to the fact that they assured the internal controls were there. Now, a lot of this is in the direct wake of some of the financial accounting scandals. Frankly, the word scandals is not over the top, I don't think. Of the early 2000s, in which Enron was as I've said before, was the most malevolent actor, but there were others as well, MCI and Global Crossing and whatever. And so, but without dwelling on those, a lot of these controls were enacted by government. And it's sort of a truism that if private actors can't deal with their own situations, the government will. And the accounting profession long prided itself on mostly staying away from government involvement in their activities, but they sort of lost that. So here's the signature page. Obviously, these are not signatures. This is an electronic copy. But these folks would actually sign this physically. And the two main actors here are going to be Robert Ortberg, who's the CEO of Boeing, and Brian West, who's the CFO of Boeing. Okay. And those are the two actors who signed saying that we have attested the fact that the internal controls are valid. And therefore that users can expect this information provided to be accurate so they can make good decisions. And that's essentially what the role of the SEC is for the most part. And one other thing here that I'll talk about, I'm going to kind of go back up here all the way to the top, and is this idea of where the auditors come into play. Actually, I think it's okay. And here it says, if I can find it here. Our internal control over financial reporting as of December 31st, 2024, has been audited by Deloitte & Touche LLP, one of the big four accounting firms, global accounting firms. And so as a result, Deloitte & Touche will also sign it. And they will say that we have audited statements and we believe them to be in compliance with generally accepted accounting principles. And if you get into auditing, you'll see that there's also terminology called generally accepted auditing standards. We're not going to cover that here so much, but the idea is that the auditing firm, the outside firm, which has nothing to do with the company itself, is an independent auditor brought in, paid by the company to do an audit, a deep dive, and they will have certified that as well. And if they disagree with management's, and by the way, there are sometimes areas, I don't want to get too far off off the track of the main road here, but sometimes auditors will disagree with some management conclusions as to how to do certain things and whatnot, and the auditors will disclose that. The auditors are basically CPA firms, and that's essentially what's going on here. But this is an example, and periodically throughout the course, I'll pull up different examples of different firms and what those look like. Okay. The final thing here, and I don't want to spend a lot of time on this, is the Committee of Sponsoring Organizations. This came about due to a lot of financial scandals in the 70s and 80s, and this is prior to the 2002 Sarbanes-Oxley Act, where there just wasn't very good internal control, and I think the Penn Central Railroad is almost one of the classic examples of a company that because it was really poor accounting, didn't really allow managers to understand what was going on, outside investors to understand what was going on. Nobody really knew what was happening. And we talk about the COSO, the Committee on Sponsoring Organizations. Who are the sponsoring organizations? Again, I don't want to spend a great deal of time on this, but I do want to focus a little bit because, for those of you who are going to go on to be professional accountants, these are organizations that will come up, and I don't want. Oh, here we go, and I'll bring it over here. So here we go. So the Committee on Sponsoring Organizations. I don't know why somebody made this screen so big here. Let me bring it down. And it was came out in the 1970s. Something called the Treadway Commission. James Treadway was a former head of the Securities and Exchange Commission, which is obviously the penultimate governmental regulating body. But here are the organizations. The American Accounting Association, I want to point out, for those of us who are academic accountants, the American Accounting Association has been around for a very long time. And it sort of stood independently from the American Institute of CPAs, which is this one right here. The AICPA sets the rules and creates the exams that regulate, that certify CPAs, and most states are in line with whatever they do because CPAs are state certified. But the AAA, the AAA are academic accountants, and so it's a little bit of a different role. And for a long time in history, a lot of academic accountants were not CPAs. Today, that's not quite so much the case. Institute of Internal Auditors, they also have a certification called CIA, Certified Internal Auditor. IMA, which is for those cost accountants or managerial accountants, and then Financial Executives Institute. So those are the sponsoring organization. So what does this organization do? They sort of lay out some of the rules for internal control, and that's really what's going on here. Is the idea they want to sort out, they want to root out fraud and find out what the causes of fraudulent reporting are, and sort of set standards for those. And so, if you're really interested in that, feel free to sort of delve into it. It's something that doesn't come up a lot on a day-to-day basis for most accountants, but nonetheless, it is an overarching organization. It's a nonprofit. It doesn't really have any regulatory authority, but it does have sort of a moral authority in that regard. Okay. All right, so let's kind of move on here and talk about internal control and procedures, and particularly regarding cash and cash receipts. So we talk about separation of duties, or sometimes called segregation of duties. What are we really talking about here? We're talking about the idea, your text gets into some examples of how we have different parties doing different things. And so step one, employee A opens the mail and gets a listing of all the checks that come in, if they're being paid by customers and whatnot. And then they're passed up to another employee who takes those, verifies the amounts and whatnot, and then takes them to another party. Now, I don't know how many parties are involved here. I think more than 3 people is probably a big number, but at least 2 certainly are involved in this idea of what we call dual control or separation of duties. It's the idea that we want different parties involved, because it's a little bit less, unless the parties are colluding, which in itself is another separate management problem. Unless they're colluding, they're less likely to do it. It is believed that there are other parties involved. So, and then somebody else enters it into the accounting records. And so we're talking about separation of duties here. Whatever it is, whether it's paying invoices, in the form of checks, whether it's receiving cash or checks from customers, whatever the case might be, usually multiple parties, sort of spreads out the risk because you've got different parties involved. And the only way I shouldn't say the only way, but one of the ways that internal control can be disrupted is if there's collusion and cooperation on the part of actors. Now, by the way, this is not unusual. That does happen. In fact, it sometimes involves managers themselves and managers overseeing people who are handling cash. So this is a peril that businesses have to deal with, is the idea of how do we deal with cash. And I'm talking about cash as cash itself. Checks are one thing that's a little bit trickier to deal with checks and to manipulate. I think, at least I think they are. But cash is obviously, if cash goes missing, it's missing for good, and it's probably not going to come back. And so as a result, the safeguarding cash and the control over it is probably self-evident in this regard. So what are the procedures here? Preventing any unauthorized payments, and also any disbursements should be made by check as opposed to cash. There are a lot of businesses, by the way, that don't deal with cash at all, and I can understand that. Every business I've ever dealt with, outside of retail banking, which I started out in my career, everything was done by check or electronic item, but no cash, in other words. And so there was a control between issuer and recipient, and that nobody can really interfere with that. So, and that's one way to do it. And also the issue of expenditures being authorized, and any kind of outgoing funds to cover expenditures, pay invoices, payroll, whatever, insurance costs, whatever the case might be, have to be authorized by the person who is in fact authorized by the board in order to do that particular thing. Okay. All right, so those are elements of internal control. These are some of the elements that the CEO and CFO are sort of attesting to when they attest to the Section 404 requirements. So a quick concept check here. Which of the following is not an element of a good internal control system? For receipts and disbursements of cash, A, maintaining a separation. Well, that sounds right, because we're talking about what is not an element. B, ensuring all checks are signed. C, having the most senior employee handle cash disbursements. D, making disbursements with checks rather than cash. Well, there's nothing really about the most senior employee. I mean, the most senior employee is the CEO, and CEOs don't sign checks typically. I'm not saying they never do. In smaller businesses, yeah, they probably do. That's not really what's at play here. So So the answer is C. It's not so much who is senior, it's who is authorized to do it. And this is where internal control fits in as a function of management. It's a function of financial management. It's a function of management that takes into account these accounting requirements where we're seeking to control. And by the way, internal control has got lots of arms and legs to go a lot of different areas here. It's a little bit beyond what we're doing in this course here. We certainly get into a lot more in auditing, but internal control is definitely a management function. And I know that as a former manager, I spent lots of time just focusing on control generally, not only in the form of cash, but in other areas as well. Okay. All right. So we talked about cash as being that top line item on the balance sheet on the left side, right? Sometimes there's restricted cash that is not really a current asset because it's money that's been set aside for particular reasons. Okay. And we have to really understand what the maturity of that or when the expected use is going to happen. And oftentimes it's used to extinguish a debt, whatever the case might be. And so let's talk about some examples of what restricted cash tends to be associated with. And some examples are things like cash set aside for things like debt retirement and so-called sinking funds. And your text talked a bit about that. And that's the idea that companies will borrow vast amounts of money in the bond market, and maturities come due at different times. And or one time, it doesn't really make any difference. But the key point is that the funds set aside to actually retire the debt are included in the sinking fund. Now the debt can always be refinanced just like you can refinance your car or your house or whatnot. Maybe not just exactly, but you could do that. But a lot of times companies will want to retire the debt because the asset that the debt funded is also declining in value. Maybe it's a building or a facility, or a product line, or a company that's being acquired is also, sort of losing value. And so, as a result, sometimes companies will set aside funds in order to make both principal and interest reductions on those. And so that would be restricted cash. And that, therefore, it would be non-current. Those would be non-current assets. Yes, it's cash, and probably invest in something, like bonds or whatever, some sort of investment that kicks off a return. But nonetheless, it is not current. And so as a result, we've included non-current assets. In other words, long-term assets. If it's a very short-term issue, then it's likely going to stay in current assets. What are some other examples of this that I can think of with regard to restricted cash? Are things like legal judgments where companies are being sued by somebody, so the company at hand is a defendant, and there are various ways in which we recognize that the liability, which is then segregated in terms of the cash. So we have an asset side transaction where we're moving cash and putting it in a restricted fashion. That's a debit, and an offsetting liability is a credit. And that really has to do with what the expectation is as to what the outcome of litigation is. And so there are various stages of that. And if you're really interested in that, we can get with me individually on that. But there's some different stages, usually advised by legal counsel. And by the way, one thing I'll say, and I've said this many times before, but if you look on the financials of any public company, they're almost always, all of them are involved in some litigation somewhere, either as a plaintiff or what is probably more likely is as a defendant for who knows what. And it's not always just private parties who are saying, hey, you hurt me because of your product or whatnot. And it's oftentimes governments, whether it's US government, state governments, local governments, European governments, whomever. And so companies are oftentimes, defending lawsuits or legal actions against themselves. And when it looks like the judgment is going to be rendered against them, then they start to move money away from that. So that can be a part of restricted cash in that regard. Also, I think we probably set aside funds for stock repurchases or for things like, stock redemptions and whatnot. Buying back stock or debt redemptions. Also setting aside funds for bonuses and whatnot. So lots of different areas in which are involved in restricted cash. The key issue is, do we delineate between current and non-current? And it really has to do with what the term of the obligation is. Okay. And finally, we talk about compensating balances. Compensating balances are one thing that I'm a former banker. I was a commercial lender for a lot of years. This is one of the things that was one of the most difficult things to talk about with customers. And that's the idea that as part of a as part of a loan obligation, as part of a loan agreement between bank and borrower, the borrower being a company, the bank would extend funds, which create a liability, right? But they also wanted assets on the asset side to partially compensate them for that. And that is the idea that the borrower was asked to maintain a certain level of what we call compensating balances. And I know your text talked about this idea of low interest or non-interest. My experience is these were non-interest bearing accounts, i.e. checking account, where they had to maintain a certain balance. And the degree to which lenders enforce this is, I think, sort of variable. We were sometimes reluctant to enforce this portion of a loan agreement, this particular covenant where we asked people to maintain a balance. Because, checking account balances fluctuate, they go up and they go down. But it's very difficult to explain to customers why this is the case. What's essentially happening is this. The bank is telling the borrowing company, we're going to lend you whatever it is, $1 million or whatever the case might be, and you got to maintain $1 million on deposit at the bank, and you can't draw upon that. It's got to stay there. So that what? So that we can use it. We, the lender, can use it as part of our compensation for the overall transaction. It's a difficult thing to describe to borrowers. They don't like it very much, and I don't blame them for not liking it very much. And what it does is, as your final point here on the slide points out, is it raises the effective cost of borrowing, mostly because of the fact that there's a foregoing of interest revenue on the part of the borrowing company because they have to set aside funds. And so here's an example. The textbook uses an example of a company borrowing $10 million from the bank at a rate of 12%. And again, 12% is a pretty high rate. Let's not worry about whether that's right or wrong. Just let's kind of go with the math here. The bank requires a $2 million compensating balance to be held in a non-interest-bearing checking account. So they can have more than that they can draw against it, but we're asking them to keep at least $2 million at all times in the account. So what's going on? We take the 10 million times 12%, that's $1.2 million per year. But keep in mind, though, that we're actually borrowing a little bit less than that because the $2 million is really money we're lending back to ourselves, right? And so as a result, the actual borrowing is not quite 2 million, it's 8 million because the fact that we're actually borrowing the borrowing company in this case, are borrowing it back from ourselves. And so 1.2 divided by 8 million, 1.2 million divided by 8 million is actually 15%. So obviously, yes, the math is straightforward here. It's greater than 12%. So it does raise the cost of borrowing. And this, and we could do a lot of discussion about how we price bank products for commercial customers. Some of them are very complex, and a lot of CFOs and controllers are very wise to what's going on. In smaller businesses, they just really don't quite get it sometimes, and is sort of a challenge and whatnot. But compensating balances is just simply a way that the bank earns extra revenue. And by the way, they do it in a way that is a non-taxable event to them, frankly. I mean, they'll earn whatever, they'll pay tax on whatever they earn from it, but it's not part of the interest revenue itself. And so it may be deferred for whatever reason. So there are reasons why lenders do this. And it's just something that really requires a lot of salesmanship, frankly, on the part of lenders in order to get this done. And over time, a lot of borrowing companies, have other options, and particularly for smaller companies, small, mid-sized companies, maybe under, say, 200 million in revenue, they pretty much have to, play along with banks. They can shop around and whatnot, but they're not going to probably find different terms. I know there's this fantasy among a lot of small businesses that they can get better terms elsewhere, but not really. But as you get bigger, you have all kinds of other options that open up, and that's where banks sort of fall by the wayside. And we'll talk a bit more about the different options that companies have to obtain cash in the short run. Okay. All right. And so quick concept, effective interest rate. So this is the similar transaction here that we talked about previously. Jenks borrowed $13 million from a bank at 10%. Bank requires the Jenks to maintain $3 million. And so, well, the math is pretty easy. You take $3 million away from $13 million and you get $10 million. And 10% of $13 million is $1.3 million divided by 10 million. So the effective rate is going to be 13%. So the math is relatively straightforward here. And what it does is it actually increases the effective rate to the borrower. Now, when it comes to the accounting for this, some of this is what we call opportunity cost, because the fact that that $3 million in this case generally is not available to be loaned out or to earn interest at all. My experience is compensating balances pay no interest whatsoever. And in fact, there are some legal issues about banks paying commercial customers interest on checking. So it's what we really refer to as opportunity cost. And opportunity cost is more of an economic term that we really don't recognize as an event to be recorded, either in financial or tax accounting. But it's nonetheless real. It's nonetheless real, and so we have to sort of make sure that we're understanding that relationship. Okay. All right, and then real briefly here, there's only a slight difference here between the international standards and what we're doing here in the form of GAAP. And the main thing is dealing with overdrafts. I don't know how common overdrafts are. Overdrafts are usually treated as a liability, as a current liability on the balance sheet. But most companies will not want an overdraft to show as a current liability in their financial statements. They'll go through great lengths in order, as they approach a statement cycle cutoff, so that they don't year-ending statement or a quarterly statement, whatever. They'll do whatever they can to avoid that because it just looks bad. An overdraft is simply a case in which checks have been written or debits, withdrawals from an account exceed the balances in the account, and the bank honors them, creating a negative balance. And so you don't have a positive balance like we would expect as an asset. Instead, you have a liability because it's a negative balance. Okay. And in this case, US GAAP really requires that we create it as a current liability. IFRS allows us to offset other deposit accounts and report a net figure. Which do I like better? Probably the GAAP standards, because it does show that there's no overdraft going on. I will say that companies that are not subject to GAAP, sometimes I've seen accountants report GAAP as a negative cash figure on the left side. Instead of cash as being a positive figure on the left side of the balance sheet, they would actually report it as a negative. That's obviously not the GAAP rule. We would move it over to the right side and make it a current liability. But those are GAAP reporting versus non-GAAP. And a lot of companies, the majority of companies in this country, do not adhere to GAAP standards because of that particular issue. But we definitely do want to refer to GAAP as our sort of guiding light here as to what we're doing. Okay. All right. So those are the differences there between those. Now let's get into sort of the heart of what we're doing in this chapter. We're talking about receivables. Accounts receivable, also called trade receivables. These are amounts that are due to be received from customers, buyers of our product or service, whatever it is we're doing, right? And again, when we create a receivable, we have the expectation will be paid. If we have a lesser expectation, that we have to make an allowance for that, but we have a reasonable expectation that we'll be paid, for what we've done previously. Because remember, when we talk about an account receivable, we're talking about a good or service that's already been delivered, and yet payment has not been received yet. So you record the revenue, that's a credit balance, right? And then we post a debit accounts receivable. So what receivables are simply this idea that we're going to collect at some point down the road for what we did at some point in the past. Hopefully not too distant past, because we like to collect faster than shorter. That probably goes without saying. But the idea is that it's recorded when the obligation is satisfied at the point of delivery. This ties in a lot with what we talked about in Chapter 6 with regard to revenue recognition. And when do we get revenue recognition? Now, remember, the example we talked about in Chapter 6 dealing with revenue recognition. One example was of a long-term construction contract, which is sort of almost the exemplar of revenue recognition over long time periods. And we may bill things that have not yet been earned yet, right? But once we earn them, we can move those over to accounts receivable, right? And that's what's really happening here is the idea we have to have earned that money in order to actually call it a receivable. Okay. And they're often very informal credit arrangements. And I think this is important here. Probably should underline the idea of informal. How formal and informal really depends upon the relationship between buyer and seller. We're usually talking about business-to-business transactions. It's not common you can go into a barbershop and get a haircut and say, I'll pay you in 2 weeks or 30 days or 60 days or whatever, or they're offering me a discount for early payment. That's not really common in consumer transactions. What is more common is these relationships that exist between businesses wherein I ship you 500 pallets of paper towels or whatever, and you pay me in 30 days or whatever the arrangement is, right? It's because why? Because I mean, do you expect the train or the trucker to collect the cash and somehow make it, or the check and make its way back to us? That's a third party that typically is not involved in it. Whatever freight is being paid is between buyer and seller. That's not really what's going on here. We're simply talking about the fact that there's a receivable being created. It's a credit sale, basically. And if you're a seller of goods or services for that matter, you're actually extending credit to the buyer for whatever period of time it is. And we'll get to discounts here in a second. Discounts for early payment, which we call cash discounts. And we almost always classify these as current assets because it meets the definition of what a current asset is. And what is that definition? Those are assets that are expected to be converted to cash within a year or the operating cycle, whichever is longer. And in many cases, yes, I know there are some firms and industries that have very long operating cycles, but within a year is usually well beyond most industries' operating cycle. Simply put, the idea of taking goods to buy inventory, if it's a merchandising operation, to buy inventory, sell them, collect the receivable, pay off the or collect the amounts and whatnot. That's usually measured in days, not years. And so that's what the operating cycle is. Okay. So that's what a receivable is. We book it as a current asset. So it's got a debit balance account. And we'll talk about the issues about collectability, because one of the things that comes up a lot when it comes to receivables is, okay, all right, so we recorded a revenue. I sold goods. I'm a wholesaler let's say I'm a manufacturer in Detroit and sell goods to a retailer in Cincinnati. How do I know I'm going to be paid? Well, I don't know, but if you think you're not going to be paid, do you want to engage in that transaction in the first place? And this is really sort of a credit policy sort of function on the part of sellers is, do I want to sell this customer on credit? And maybe I don't, and maybe this customer is in bad shape, and I want to sell them on COD, where they do have to pay the trucker at the time. Now, truckers don't often like that, but if we pay them more, they'll sort of deal with it. But the credit terms really vary depending upon the relationship. There is no question about the fact this is a credit relationship. As we sell goods from seller to buyer, there's an obligation to pay over a very long time period. So, and the initial value of the receivable is the idea it's equal to the amount that is entitled in terms of revenue, right? Okay, and remember, once we satisfy the performance obligation, we create a receipt. So let's go back to the seller's point of view here. If we've satisfied that, I've shipped you 50 pallets of paper towels, or whatever number it was I said a minute ago. I've done my performance obligation. Now you need to pay me, and you need to pay me in whatever it is, 30 days, 60 days. And oftentimes these credit terms are sort of dictated by what's customary in the particular industry, or which have been negotiated separately between buyer and seller. So it's not always a one size fits all sort of thing. Okay. And then obviously, if there are multiple or multiple performance obligations, then these transactions are allocated among those. And there are some potential complexities. We'll talk a bit about these. We talked a little bit about those in chapter 6. And we'll get to those in just a second. Before we do that, though, we should talk about trade discounts and sales discounts. These are two different things, both of which have the effect of reducing the price to the buyer for various purposes. When we talk about trade discounts, we're talking about some reduction, usually expressed as a percentage from what we call the list price. The list price is it's almost like, I would think of it as like going to buy a car and you see a list price for a new car, and somehow that's not the actual price you're going to pay unless you're completely out to lunch and you decide to pay the full price, which I'm sure somebody will take you up on that. But the list price is sort of the starting point for prices going downward. And they're reduced for all kinds of different reasons. Quantity discounts are a big one. The bigger the buyer you are, you're going to get a lower price per unit on the goods that you're buying, okay, or the services that you're acquiring, whatever the case might be. And so quantity discounts are a big one. This is also one explanation for why bigger firms get bigger, smaller firms get smaller, and they go out of business. And at one time, there used to be, throughout the country, lots of family-owned grocery stores and mechanic shops and tire stores and pharmacies and whatnot. And they just simply could not compete with the size and scale of the bigger firms. And so they're largely gone. They're not maybe all the way wiped out, but they're mostly they're mostly gone. And that's because of the fact that quantity discounts are there. And by the way, the buyers themselves are well aware of their own bargaining power. They oftentimes, negotiate for these discounts. But it's not just quantity discounts. It could be other issues as well. It could be you've been with us for a long time. We want to maintain a relationship. We'll give you another discount. And some of these discounts sort of add on other discounts. It could be that it's a new product being offered by the seller, and we don't know how it's going to do. So we want to entice you to put this good available, particularly if you're a retailer. We don't know how this good's going to sell, but we'll make it worth your while to give you a discount on this particular good. It goes on and on and on. So trade discounts are those things which are quite variable, and by the way, are not available to every buyer. Bigger buyers get more discounts than smaller buyers, and it's just kind of the way it is. And so, but these are all expressed as percentages off what is some sort of nominal, and frankly, it's almost an irrelevant or sort of made up fictional list price. Okay. All right. So that's it. We'll talk about sales discounts or or sometimes we call it cash discounts. And these are different discounts that can add on to trade discounts. Now, by the way, any kind of trade discount, all right, and this is important because this is a question that comes up all the time from students is that we talk about discounts, we say net terms, right? And we say, well, what do we mean by net? Well, net is after all these guys here. So if we get a 10% discount for whatever, this big who we are, we get a 10% discount. It means the list price times 90%, which is 1 minus 10%, is going to give us what we call the net price. The net price then is what is at work when it comes to discounts for early payment. Okay, discounts for early payment. These are different altogether, and they're not always available to every buyer. In fact, not all discounts are available to every buyer across every industry. Even within the same industry, sometimes they're not available. But a cash discount, in this case, what the text is calling it a sales discount, is a case in which if a customer pays within a specified time period, they get a discount. So, and one particular methodology is the 2% discount if paid within 10 days of the invoice date. And the invoice date is simply the date at which the invoice is created, and it could be the date of receipt of goods, or it can be the shipping date, but it's usually the date, whatever the date on the invoice is, and they're going to be paid within that period of time. So if the buyer pays within 10 days, they get a 2% discount off that net price. Otherwise, the net amount, which is net of all this, if there are any, is going to be due in 30 days. Okay, so 2, 10, net 30 is one of the more common sorts of shorthand that we see on invoices. And if you look at invoices as an accounts payable person, you probably will see that. And this is not the only form of discount that we get. 110 net 30, 110 net 60. There are all kinds of other arrangements. We cover a lot in business math, business 1180. Sometimes it's receipt of goods because we don't know when the goods are going to get there, and the discount period starts at that point in time. The key thing is the discount period is a limited period of time wherein buyers are incentivized to take advantage of a discount because it's worth their while to do. Now, why on earth then would a seller offer a discount? Maybe the seller needs the cash. Why would the seller need the cash? Well, think about this. You're a seller of goods. You're producing a good or a service and whatnot, and you're offering it to a customer who's not going to pay you for a while. But meantime, you've got employees to pay. Employees don't work on credit. It doesn't work that way. Labor laws, in fact, prohibit that. And you're going to pay a worker within, I think it's 15 days of their last day of work. Otherwise, you're in violation of labor law. That's no bueno. Nobody wants that. So meantime, so you've got a cash issue where you got to pay workers and everything else, materials and whatever else might be involved, and yet you're not collecting the receivable. You just can't say to workers, "Hey, we'll pay you once we collect this receivable." That's obviously absurd. We all know it's absurd, and so as a result, a lot of companies will say, "Pay us early, we'll give you a discount." Now, the good news is, if you're a buyer and you're offered something like a 210 net 30 arrangement, you probably ought to take advantage of it. I'll talk about why that is the case in a second. So the slide package is ordered in a strange way here, and we'll get to the advantages here in a second of taking discounts. But let's talk about how we record the transactions in the first place. There are two different methods, and they both have advocates on either side. I don't know. This is not a debate that involves barroom brawls among accountants. Not that there are too many of those, but they're just different ways of recording these. And so in this case, let's take this example. Hawthorne Manufacturing offers its credit customers a 2% discount. They pay within 10 days. So it's a 210. Otherwise, they pay the balance due, the net amount, net of any prior discounts, which have nothing to do with time limit payment, in 30 days. So in other words, we call it 210 net 30. Okay, pretty common. On October 3rd, Hawthorne sold merchandise at a price of $20,000, and the customer paid $13,720. Not the full $20,000. And this is what we call a partial payment. So that partial payment is going to be subject to, subject to or receiving of that 2% discount. So 14,000 times 0.2 is going to get a discount. And as a result, we're going to record the remaining balance of 6,000. In the gross method, we just simply post the transactions we know it. We sold the goods, 20,000, and we record account receivable. Easy peasy, right? It's a little bit different than net method, where we're saying ahead of time, we anticipate that buyers are going to take advantage of it. And we'll come back to this prepayment issue here a little later. This is not the best way to present it, in my opinion, but nonetheless, we got to deal with what's going on. This is easy peasy, debit, credit, right? Easy. The net method, though, takes out that 2% by saying accounts receivable should be discounted by 2%. In other words, 1 minus 0.02 is 0.98, or 98%, so we get 19.6. And that's the debit, that's the receivable, the credit is the revenue, and then we get, oops, I gotta go down here a little bit, and we have another offsetting credit. This is what happens when I make the screen too big, and we have a net sales revenue. Oops, whoa, I went too far, didn't I? Oh, shoot. Sorry about that. I'm gonna shrink these down here. So there we go. All right, hold on a second. And so we have oops. I'm having some trouble getting this to work here. So I'm trying to talk about the gross method here. So we have 19,600 end sales revenue. Okay, so those both balance each other out. Now, the thing about the net method, I'm sorry about this week. A lot of these slides look a lot alike as we get deeper into this, but the gross method is simply sell goods for 20,000 we have receivable. Whether they take the discount or not is up to them. But it's almost anticipated that they don't take the discount. And I kind of like this method. I sort of am okay with it, but I know in GAAP accountants usually prefer the net method. And that is where we simply already discount the receivable, anticipating that we're going to have a 2% reduction. So the receivable is not 20,000, it's 19.6. And the revenue consequently is also going to be 19.6. Okay. That is net of the discount. Okay. And that's one way to do it. And that's the gross versus net method. Now, a lot can happen between the invoice date and whatever happens. And so in this case, let's talk about this partial payment of $14,000. It's not 20,000 minus the 0.02 or the 2% discount. It's just only part of that. So in this case, the gross method then will simply reduce the amount of receivables by creating a sales discount. So what are sales discounts and what is that account? Well, this is essentially what we would call a contra revenue account, right? Remember, any contra account is that account, which in this case, it's a debit balance account. Any contra account reduces the balance to which it refers to, right? Every contra account that is involved in financial accounting refers to some account and it brings down the balance. And it's used to sort of communicate information to users about the fact that something has happened. Probably one of in most cases, the first contra account we talk about is a committed depreciation on depreciable assets, where we've got over time, we got depreciable assets of $1 million and accumulated depreciation of 500,000 or whatever. And so that's a contra account. In this case, this is a contra revenue. And by the way, in financial accounting, we have contra assets, contra liabilities, contra revenues, contra expenses. And all they do is they're used to provide information to users about the fact that there was a potentiality of some dollar figure, but it's been reduced for whatever reason. This is not to exclude the fact that we also have adjunct accounts, which add on them. But we're not going to, that's the other direction, but we're going to talk about this particular contra asset or contra revenue. So cash of 13,720 is received. I'm sorry, 14,000 was paid. So we're wiping that out, but we only collect 13,720. Why? Because we're only taking 13,000 minus that 2% discount. So, and so in the gross method, we only record it once we know what has actually happened. But some buyers don't take advantage of the discount. That is these cash discounts for early payment. And when they do in the gross method, then we record it. We don't record it ahead of time. We do that then. So we have 14,000 receivables wiped out. And we simply, this is a reduction to revenue, which is why it's a contra revenue. Okay. And that's in the gross method. In the cash method, we've already sort of accounted for the discount. So all we're doing is simply reducing receivable, which, by the way, has already been reduced because of the allowance, the expectation that the buyer is going to take the entirety. Now, they're going to not, in this case, they're not going to take the entirety of the 20,000, only a portion of it. So only a portion of the receivable is reduced. And of course, the offsetting debit then is to cash in that case. Okay. All right. So that's essentially what's going on in that transaction. Okay. Let's move on here. All right. So Hawthorne Manufacturing, again, the same deal, but they still have 6,000 outstanding, right? And in this case, the buyer is not going to be able to make the other 6,000 within the 10-day period, so they're going to pay the full amount. And so as a result, the gross method, no big deal whatsoever. We knew we had 20,000 receivables outstanding. We have already eliminated 14,000 of it, which we had to adjust to the discount, which we've done. And it's reflected in the reduction in revenue that brings that down. That's over here. But we've credited the 14,000 in the gross method here. Now we're collecting we're reducing it by 6,000. So as a result, that transaction is now zeroed out on the receivable side. Okay, we've taken that to a credit balance, it's gone, now we have the cash. In the net method, though, we still get the same 6,000, because remember, how we record it on the supply side makes no difference as to what the actual facts are. We're still going to collect, $6,000 after that 10-day period, that discount period is elapsed. And so all we're going to do is simply reduce that 6,000 remaining, which was previously reduced by 2%. Previously reduced, right, up front because we expect to have received it. And we're going to have another account, a credit account called sales discounts forfeited. And it's a little bit controversial. I know that I think probably most academic accountants would say this is an account you want to record because why? Because it communicates information to management about what's been forfeited in terms of discounts. And obviously on the other side of the transaction, the buyer, they might want to know what they have given up as well in terms of discounts and whatnot. But discounts for early payment are definitely needed. And when the discounts forfeited, when used under this net method, it's a credit balance account, and it basically adds to sales revenue. It adds back to sales revenue because why? Because we've already discounted sales revenue earlier up front at the time of the invoice here, because we only included 19,600. Now we partially offset some of that because of a partial discount, but the rest is still outstanding. And so as a result, this is going to go back into the revenue account as a credit balance, and so it adds to revenue. Okay. Okay, so essentially that's what's going on with that particular set of entries. Okay. Let's see, we got about 10 minutes. We got some time to sort of press forward here. And in this case, what we're really trying to do and express here is the idea, at the end of the day, how we record them is, I don't want to say irrelevant, but we're going to get the same place, right? And we're going to debit and credit different accounts. And so in the gross method, we're simply going to record sales up front. Any discounts that are taken, that was the 2% of the 14,000, we're simply going to call sales discounts as a contra revenue. And we're going to book net sales revenue of 19,720. This looks a lot like the income statement presentation. Sales revenue, a gross amount, less discounts, right? And obviously you may have returns and whatnot, and you're going to have a net amount of sales revenue. And by the way, it's net sales that we typically key off of when we're trying to do comparisons across industries and ratio analysis and all that. It's not the gross amount, it's the net amount. Okay, that's what's important. But this is the gross method, which is a little bit more straightforward, particularly when there's a lack of visibility as to what amount of discounts are going to be claimed in the end. The net method obviously only claims 19,600, and we're going to forfeit. The buyers forfeited 180. I'm sorry, 120. And so as a result, we're going to get the same result at the end of the day. Okay, just different methods of getting there, different accounts being used. I think your textbook indicates that a lot of accountants have a preference for the net method. I don't know that personally I like it as well, but it's not really about me. It's more about, what is necessary. But either really is acceptable. The net method may be a little bit more transparent in terms of what's going on in terms of the actual transactions themselves. But keep in mind, on an income statement, we're talking about lots of transactions. And so, how many of these events are really going to happen that are going to sort of sway your opinion, particularly given the fact that net revenue is not going to be altered whatsoever, right? Now, if there's uncollectability, it's another issue. We're going to get to that, but you get the idea. So it doesn't really, in the end, like a lot of things in accounting, in the end, it all sort of works itself out. So a quick quiz: which of the following is not true about recording sales discounts? The gross method records sales discounts taken when payment occurs. Okay. Net method records discounts not taken as sales discounts forfeited. C, net sales revenue is higher under the gross method than under the net method. Well, that's that. Let's just stop there. That's the wrong answer, because we just discussed the fact that everything is the same in terms of revenue recognition, right? It's just the timing is different and the accounting is different. And by the way, some companies offer no discounts whatsoever. So really the gross method is the most appropriate. And there are reasons why they may not offer it. And that's sort of where we're coming to, is the idea of why a company may not offer a discount, and why buyers like discounts, not just like them, but they love them. And those are good reasons. So, and here's what the reason really is. And so let's just take the 210 net 30 example here. So what's going on? We're sort of, this is where accounting sort of verges into finance, and there are a lot of these intersections that we see. So when we talk about revenue, we're talking about a 2% discount. What's that? So on 210 net 30 terms, what does that really mean? It means that we have 10 days free anyway, right? In other words, the seller is extending this 10 days of free credit. And so if we pay early, what we're trying to do is say, well, does it make sense for us to take advantage of this 20-day period, or to, therefore not take the discount and go for it? Or do we pay the discount and incur the value of that 20-day period? If you take 20 days over 365, because think about this, we're incurring these invoices all day long, right? And all year long. And so if we take 365 divided by 20 times this difference here, which is 2 divided by 98, that's the amount paid. It's not 2 divided by 100, it's 2 divided by 98, a 2.04% return times this factor here. You end up getting a difference of 37.23% annual effective rate. And even if you don't want to do this, this is a very precise definition. Even if you just say, look, if I get, I'm paying for 20, I'm paying extra, or I'm paying less to get to pay the invoice in 20 days. If we do this again and again and again, take 360, which is one method we use in business math. It's what's called the banker's method. 360 divided by 20 is 180 is 18 times 2% is 36%. Not too much difference. And so what does it imply? It says what? It says that if I can earn more on my assets than 37.23%, then maybe I don't want the discount. But maybe I do if I cannot. In fact, one of the things that was a selling point that bankers have been using since time immemorial is the idea that bankers, and I was one of them, would encourage our commercial borrowers to take advantage of discounts when they're offered. And we will lend you money to do that. I know that's very self-serving on the part of bankers, but that's who and what they are. But the idea is we will lend you money. And nobody is borrowing money at 37%. I mean, that just doesn't even make any sense. And so if you can get lower than that, it makes sense to take discounts. And in fact, the term discount itself, should always be associated with time value of money and what that savings is over a particular time period. I don't care, even if it's a very small ball transaction like buying a gallon of milk, you get 20 cents off because maybe you're running 2 for 1 when it does translate into a financial savings that you can actually translate to annual percentage terms. I know, the vast majority of consumers will never ever do this, but sophisticated commercial buyers will do this. And so if it's offered 210 at 30, companies will go out of the way to borrow money in order to do that, just to take the discount, and it pays off. If it didn't pay off, they wouldn't do it. Okay. To the extent where a lot of companies or sellers don't really want to offer that because they know what they're giving up, but they are sometimes forced into it because of the issues we talked about on the supply side previously. That is the idea that they've got maybe a cash crunch as well. And one of the difficulties we see everywhere in finance and accounting is the idea that you've got a receivable cycle that is much slower in terms of repayment than the payables that company's got to make. It's a bad combination where you've got to pay payables quickly and the receivables are slow. One way to speed those receivables up, to turn those into cash, is to offer a discount, but there is a cost to doing that. And in this case, it's considered, in this case, it's the 2% discount to get that money at least 20 days earlier. Now, by the way, for a lot of companies, if they exceed the 30-day period, that's the credit period. I know that a lot of accounting textbooks will say, oh, all these bad things are going to happen. Well, probably not. A lot of companies exceed that. They don't want to take the discount. They're not prepared to do it, whatever. And, or maybe their bookkeeping is not quite, all that efficient. So a lot of companies go over, which is why receivables themselves have to be sometimes marked down. On the other side of the transaction, the seller's transaction have to be marked down because of the potential uncollectability of those receivables at the end of the day. Okay. All right, so I think that's a pretty good stopping point, and we'll stop here. We're going to get to returns, which is another contra revenue, and what that means. Because remember, we're talking here about the balance sheet. We're talking about when we talk about sales and returns and discounts. Well, these are income statement items. And at the outset, I said, hey, we're talking about the balance sheet. Well, we are, but there are things that obviously go on the income statement that affect the balance sheet, and this is one of them. Not just the discounts, but also sales returns. That's not much to talk about there. And then we'll sort of delve a little bit deeper, particularly in this critical topic of what we do about uncollectible accounts, those receivables. We're selling goods on credit, and maybe we collect it all, maybe we don't. It's often the case that some of the accounts are deemed uncollectible, and we'll talk about how we do the accounting for that. So, okay. Any questions? I know we have nobody in the room at the moment, but any questions from the Zoom audience here? Okay, well, if you have questions about anything, feel free to let me know. I'm here pretty much every day, and I'm here to help you. And if you have questions, reach out to me, and we'll go from there. And I'll post this video here very shortly.